Hello everyone. In this session, I'm going to talk about the standardized measurement approach for operation risk. So within that, we are looking at what are the key elements that are proposed as a part of the standardized management approach. First of all, this is an approach for measuring the operational risk capital charge. Earlier, we had three major approaches for measuring the operational risk capital: the standardized approach, alternative standardized approach, or advanced management approach. So now it has been identified that there are some problems associated with this advanced management approach, which I am going to discuss slightly later, and that is where a new approach is being proposed, which is the standardized measurement approach, SMA. So we are trying to see what are the key elements of that, and using this SMA approach, what is the typical formula to compute the operational risk capital requirement. What are the different ways in which the operational risk capital requirement can be computed using the approach. So by looking at the key components which we are discussing in the earlier slide, we would be building the formula for computing the operational risk capital charge. So there will be a quick comparison that we would be doing between the SMA approach and the earlier approach, the AMA approach for calculating the operational risk capital. But finally, we have to understand the fact that garbage in, garbage out. So which is more like the data collection, data identification will be one of the most important aspect to compute the correct capital requirement. So that is where we talk about what is the way in which we are able to identify the data, what are the various criteria for data collection, and even how do I really treat the operational raw data. So coming to the first, the key elements, I'm looking at the business indicator as one key element, and the second element that I'm going to look at is a kind of a loss multiplier or loss component, which I would be talking about in the next slide. So these are the two major things that are proposed as a part of the new method. So business indicator is a kind of a proxy. It's a simple financial statement proxy which is highlighting the operational risk exposure. So almost all the items that are there in the P&L, the same P&L items, even if you remember the basic indicator approach or the standardized approach or even the alternative standardized approach, which are used to compute the operational risk capital, they were based on the gross income, right? So this method also is based on, so whereas the gross income actually contains the various items from the profit and loss statement itself. So here also the business indicator also has almost the same P&L items that are there in the gross income, but in gross income even the negative components are being considered. One major thing is if the operating expenses were increased, it was an indicator that the overall operational risk was going down. In the gross income approach means my expenses are going up, so the overall operation risk is going down, so a capital requirement also was going down because it was treated as a negative adjustment. Whereas in the business indicator approach, the negative adjustments were not considered, only the positive values of the components are considered, means the negative adjustments were simply taken out from the computation, right? So that way, this is much more reliable compared to the advanced management approach, which had that gross income as one of the base, or standardized approach where there was a gross income as one of the bases. So all the income statement items which can produce operation risk are all included in this approach. Whereas in gross income, some of them were typically omitted, or because the negatives were also considered, there was a possibility of netting using the gross income approach, whereas here only the positive values are considered, so there is no question of netting. So the BI is much more a robust BI. So the service component of the BI, we'll look at the detailed formula for all of that, but there is a services component of the BI for high fee banks. Now overall, the way the business indicator is computed, if I have to compute the business indicator, which is one major component of my operational risk capital. If you see the operational risk capital formula probably a few slides later, you will be seeing that BI is one of the major components to it, and along with that there is a loss component, or typically the internal loss multiplier. So we'll see, if I have to compute the BI, the business indicator for year T, just like the gross income approach, here also the banks need to compute the business indicator for the 3 years previous. Average of those 3 years of BI needs to be taken, right, and that is purely based on the average of all their components. Now here I am talking about this component, this, so within the BI again we have a detailed formula which comes out as the average of all the components. Now if you see the way the formula is computed, the BI is composing three parts: interest, lease, dividend. So this is a component containing three things which are the sources of income for the bank: the interest, the lease and the dividend, ILD component. Then we are talking about a service component. So we are doing some kind of averaging of the service component value and the financial component. So the overall business indicator is coming from three major components. One is the typical incomes: interest, lease and dividends. Then we are talking about the service component and the financial component. So I am taking the average of the last 3 years. Now if I have to look at the interest, lease, dividend average, I am talking about the absolute differences between interest income and interest expense. So average interest income and average interest expense. So whichever is, so I am taking the difference of these two and I am taking the absolute value. So whichever is the one is greater, I am taking the positive of that. Then I am also considering 3.5% multiplied by the interest yielding assets, interest earning assets, IEA. So on an average, the interest earning assets are multiplied by 3.5%. So either the interest income or the potential to earn interest multiplied by 3.5% is taken as one component. Similarly, regarding the leases, I am looking at lease income and lease expense, whichever is the higher. I am taking the difference between the two, and also I have an average dividend income. So basically I am looking at three parts. One is the average dividend income, average net lease income, and when it came to interest, either I take the net interest income or potential to generate interest based on the interest earning assets multiplied by 3.5%. So that is how I get my interest, lease and dividend component. Similarly, when I am looking at my service component, there are 2-3 components out here. other operating income minus other, I'm looking at other operating income and other operating expenses. So whichever is the higher, that is one part. And in the second part, I am looking at fee income. So fee income minus the fee expense. That's one part. I'm looking at the maximum of either the net fee, or if you see the other side, I'm looking at fee income and fee expense, and unadjusted business indicator is coming into picture. So 50% of the unadjusted business indicator for this high fees that is being charged. So this is a formula: zero point 0.1 times maximum of the I'm also taking again the fee income and the fee expense average minus 0.5 times unadjusted business indicator. So I'm doing an unadjusted business indicator, and based on that I'm computing the service component. So the unadjusted business indicator is coming based on this. I take the ILDC average from this stage. Then depending on whether my other operating income or operating expense is higher, I'll be considering that. I'm not taking a negative of one over the other. Similarly, fee income versus average, whichever is the highest, I'm taking that. And also I'm considering the average financing component. So that entire thing is what is leading to my unadjusted business indicator. And based on that unadjusted business indicator, I'm actually computing my service component. And when it comes to the finance component, it is from the net profit and loss. I'm looking at my trading book average. So the net P&L from the trading book related average, and also I am looking at the banking book average. So the trading book average versus the banking book average, I am looking at their net P&Ls, and I am taking their absolute value. That is what is giving me the financial component. So all this put together is giving me the business indicator based on the business indicator for the standardized measurement approach. Now once I am able to compute my business indicator, this entire banks are, all set of banks are divided into 5 buckets. So if the business indicator is between 0 to 1 billion, then the BI component is 0.11 times the business indicator value. But if it is between 1 billion to 3 billion, it is 110 million plus 0.15 times whatever is the excess. Similarly, if the business indicator is between 3 billion to 10 billion, this works out to 410 million plus 0.19 times again whatever is the excess over 3 billion. So it goes like this. So which talks about how much should be the portion of the BI as a part of your operational risk capital. So a baseline level of capital is so when you are talking about the capital, there are two components of it. One is the baseline, which is computed using the BI. So either using one of these 5 buckets, the BI value is actually computed. And whatever is the portion of the BI that is above the threshold, there is again some kind of a function which I am going to look at in the next one, that is purely based on the different risk profiles that are associated with different banks. So to understand that, we are talking about an internal loss multiplier and a loss component. So till now, if we have seen the SMA model, this model is built on the assumption that the relationship between the business indicator and the operational loss exposure is very stable. So we can very well express the entire business indicator value. From the business indicator, we can compute the operational loss exposure value. So from there, you could also make a clear-cut interpretation that the banks which are similar in terms of BI, the capital requirements also will be similar for them. But The operational exposures could be very different, though their BI values are the same. The exposure to the operational risk could be very different, even though their BI values are the same. Now, that kind of an exposure to operational risk is what is taken care of by the loss component, which is an additional component that is added to the BI part, so that the overall risk sensitivity of the standardized measurement approach comes into picture. So it is observed that the entire internal loss experience is typically taken care of by using the internal loss multiplier, which is coming through this particular formula: log of exp of 1 exponential e to the power of 1 minus 1 plus loss component by BI component. So whatever is the BI component, which we got in the earlier case, and for the loss component, this is how the formula is coming: 7 times the average total annual loss, 7 times average total annual loss only including the loss events above 10. So those events whose losses are above 10 million, there is some more pressure, some more increase in the multiplier. And similarly, 5 times the average total loss only including the loss events above 100 million. So you could see, if the losses are above 100 million, the severity is much higher. First there is a multiplier by 7, then there is a multiplier of another 7 for those which are exceeding 10 million. Again there is one more multiplication by 5 for the losses that are exceeding 100 million. So that is what is giving me the loss component, and based on that we are getting the internal loss multiplier. So it says that bank should use 10 years of good quality loss data to compute that loss component. So if you are saying that loss component is equal to the BI component, these two are equal, so the ratio is 1. So it becomes log e to the power of 1. Multiplier is log e to the power of 1, which is nothing but 1 itself. So a bank with loss component equal to BI component is a bank with exposure at average of the industry. So the loss multiplier is 1, and if the loss multiplier is 1, SMA is whatever is the standardized measurement approach capital, that would be more or less based on the BI component itself. And if you see the ratio to be 0, loss component, let's say, works out to 0, which is what is the minimum loss that is possible, then the internal loss multiplier is going to be logarithm of e to the power of 1 minus 1, which shows that it is approximately equal to 0.541. And the logarithm here is clearly denoting to me, the logarithm in the formula overall is denoting that the loss multiplier would be increasing at a decreasing rate with respect to the loss component. So overall SMA capital computation comes like this: you take only the BI component, no loss component if the bank is falling in bucket 1, and otherwise you take 110 million plus BI component minus 110 million multiplied. So this excess we are multiplying with the loss component, internal loss multiplier. So the internal loss multiplier is coming out with this kind of a formula. So overall the BI component is coming out to be more like this: 0.11 times BI if it is bucket 1, 110 million plus 0.15 times BI minus 1 million if the bucket is 2, and so on, which we have already discussed earlier. Similarly, the loss component is computed through this formula. So whatever is the adjustment from the 110 million for the BI component, you are subtracting that from 110 million, and whatever is the excess that is coming out, we are multiplying it with the internal loss multiplier to finally arrive at the operational risk related capital requirement using the SMA approach. So if I have to compare, earlier we had so many approaches: the advanced measurement approach, the standardized approach, alternative standardized approach. All of them, they are required to collect the operational losses, and even they have to report these losses to the supervisors. So specifically talking about the AMA approach, so estimation of the regulatory capital, just like the way we have computed the capital, it is purely based on various internal modeling practices. I can create my own models and I can share them with the supervisors, and provided they are accepted by the supervisors, they can be very comfortably used for computing the operational risk capital charge. But now that proposal, which was having more and more of a flexibility earlier, was getting replaced. There are so many reasons for proposing a replacement to that kind of a more flexible approach, which is really giving a lot of importance for the internal models that are generated by the banks. So we are trying to look at why it was getting primarily replaced. So the supervisory experience, whichever has been shared with the supervisors and the supervisors responding to the internal models, it has been a mixed response. In some cases, it was very positive, whereas it was negative in some other cases. There is a lot of inherent complexity of the AMA approach. Comparability of the various AMA models was lagging quite heavily, because every bank was having its own set of internal modeling practices. So the comparison of the capital across the banks was becoming a big difficulty, right? And even the risk weighted asset calculations have really shown too much of volatility across the banks. So whatever were the capital ratios that were computed, the confidence was completely lost. And this is where there was a good motivation for the existing AMA model to be replaced with the new approach of the SMA. Now, whatever is the approach that we are talking of, the data collection, identification, treatment, everything are very, very important. Once those are in place fully, then the simple calculation aspects driven by the formulas, etc., are more straightforward. So there are some general criteria for identification and some specific criteria that are there. So whichever are the internally generated loss data calculations, they must be based on a 10-year observation period. But let's say the bank is moving for the SMA approach for the first time, which is in the first few years. Even a 5-year period is okay, especially on an exceptional basis, especially when you are talking about having good quality data not available for more than 5 years. Only if the good quality data is available only for the last few years, at least 5 years, but definitely not 10 years, then this can still be taken up on an exceptional basis. Now, when you are talking about internal loss data, they should be linked to the current business activities of the bank. It should be very clearly linked to the technological processes and various risk management procedures. So there should be a lot of interconnectivity between all of them. And there should be a clear-cut mapping, historical internal loss data to various supervisory categories. It should be very, very comprehensive. All the material activities need to be captured. These are very simple things, right? All the systems that are involved, all the geographies, the data needs to be captured. And similarly, any risk event that is occurred, lot of details need to be captured about that risk event. The date when the event has occurred, right? Or especially the date of occurrence of the event, the date on which the bank became aware of the event, which is more of the discovery of the event. So from when the loss reserve provision against the loss was recognized in the P&L of the bank. So it's more and more of accounting of that particular event in the financial statements of the bank. What are the kinds of recoveries of the various loss amounts? What are the key drivers or the causes of the various loss events? To whatever extent possible, all these details need to be captured in depth. And develop specific criteria for assigning the loss data arising from an event. Is it from a centralized function? Right? It could be because of an IT error, or what kind of function from which the error is cropping up, and any kinds of related events over time are there, all needs to be captured accordingly. Now these two are very important bullet points here. See, there are some operational risk related losses which were related to credit risk. Instead of they being captured historically in the operational risk databases, they are captured as a part of credit risk databases like collateral management failures, etc., which are actually operational risk procedures, but they are captured as a part of the credit risk databases. They'll still be treated as credit risk for the calculation of regulatory capital. So they would not be considered as a part of the SMA because they will not be treated as a part of operational loss data. So they would not be included for the computation of SMA. Whereas those losses that are related to the market risk earlier were treated as a part of so operational losses which were a part of the market risk. Earlier they were treated as a part of market risk databases, but now they will be moved to the operational risk databases. So they would be considered for the purpose of calculating minimum regulatory capital. So the credit risk related operational risk events will not be moved, but market risk related operational risk events will be moved to the operational risk database and would be useful for the computation of SMA. Now coming to the specific criteria, there are few aspects. So we are talking about building an SMA loss data set. There should be a clear policy in the bank on what criteria, right? Based on what criteria any loss will be recorded in the internal loss event database, and which of them will be included for the purpose of calculation of SMA regulatory capital. So I need to have a very much proper SMA loss data set from the internal data, but if I have to develop that, I should have clearly defined policies and procedures, right? What is the meaning of gross loss? What is net loss? What is recovery? How do I talk about the reference date and grouping of the losses? All these things become very, very important if I have to collect the data for the measurement of the capital based on the SMA approach. So if I'm quickly looking at some of the definitions, gross loss is a loss before the recoveries. So I'm not considering the recoveries, it's an overall loss. But after I take into account the recoveries, whatever is the net that I am left with is the net loss. Now recovery is more or less an independent occurrence. It's purely based on the original loss event, right? So recovery again differs from party to party. It's based on the original loss event, and to what extent there are inflows and outflows that are happening from the third party. So that could be one of the major source of recovery. So there should be a clear-cut identification from the banks. What is the gross loss amount altogether? Recoveries, how much are they? One, insurance related recoveries, how much is coming because of the insurance policy and how much is a non-insurance related recovery. All needs to be very discreetly identified. So for the overall inclusion as a part of the SMA capital, the direct charges which are impacting and impairing the settlements. So whichever are impacting the P&L statements of the banks, the direct write-downs that are happening on the P&L because of the operational risk events, the costs that are incurred of the costs that are incurred as a consequence of an event, right? Cost of repair, cost of replacement, the provisions in the P&L against the potential operational loss impact that is going to come up. So all these things are sometimes the ones that are booked under suspense accounts, but if the financial impact is more or less a known element out here, all these things can be included as a part of the SMA computation. But those expenses that are related to general maintenance on property, plant, equipment, which are a very common kind of stuff, because they are not unexpected, they are expected kind of stuff, right? And any kind of an expenditure that is involved to enhance the business after the operational risk event, even the insurance recoveries that are coming, or some kind of modernization related expenditure that I am doing, some kind of improvisations after the operational risk event, that expenditure will not be included as a part of the SMA capital, and even the insurance premiums also are not included. Then regarding the reference data, either the date on which the operational risk event is discovered, or the date on which there is a provision for it made into the financial statement. So that date needs to be taken as a reference date, but definitely I cannot use any date that is after the date of accounting. So that should be the worst possible date that needs to be taken. And it also says that the losses which are occurred because of a common operational risk event, they should be grouped. And the entry into the loss database should be as a single entity itself. So which items need to be grouped? What is the criteria for grouping of the items? For all those things, there should be a clear-cut policy in place from the companies or from the bank's perspective. What kind of methodology, what kind of data that is required for the grouping, based on the risk, even the risk management, the for risk management purpose, or even the regulatory capital calculation purposes, what kind of data needs to be grouped and entered into the database. There should be clear-cut policies in place. So this is where we need to understand, when we are moving away from the existing AMA kind of an approach to a new SMA kind of an approach for operational risk capital computation. These are the various dimensions that we have to keep in our mind. If you have any further queries regarding the same, you can very well get in touch with me by giving me a call on the number that I have given below, or you can send in an email at the email address provided. Thanks a lot for listening to this session. Thank you very much.